in because we got lots of good content to go over today. So some of the more popular times that premium increases happen will be, at renewal, but sometimes they also happen during a transaction, like adding a car, adding a driver, but sometimes it happens when the clients are going to assume the price is going to go down and then it goes up. And that's a real fun conversation, right? So we're going to talk about both of them, like how we're going to deal with both of those. Also, the amount of the concern will vary from person to person. And I don't mean that, somebody with money won't care as much as somebody who isn't ultra wealthy. It's actually typically a personality thing that one person will just go crazy over a $5 increase and it's just principal to them and they're mad about it. Even if they have plenty of $5 bills laying around, they're mad about $5. And then there will be other people that you're like, I do not want to say how much this is going to cost to add this person or this. And then you're terrified. And then you say it and they're like, oh, okay, that's fine. Because maybe they were told it was going to be an extra $300 a month and you're only quoting $200 a month. So the amount of concern will definitely vary from person to person. And sometimes I feel like we get very worked up about things unnecessarily. Like we do more damage to our confidence and our nerves ahead of the call or the email than if we had just made the daggone call. How they react, you're like, oh, that wasn't so bad. Why did I spend 45 minutes working myself up to make that phone call? So, you keep that in mind that not everybody is going to bite your head off. Some people are, but not everybody. And then how you deliver it matters, right? Which is why I'm doing this call, because I think a lot of these things, when you're looking, especially if you're with a captive agency, when you're looking at things through tunnel vision, like this is the only product I offer, this is my only option, sometimes it can just feel like you're alone on an island and no one else is going through rate increases. And that's just simply not true. There are other companies going through increases and there are other companies that are not going through increases. But many moons ago, I had a brilliant agency manager. She's still at the agency. And she had told me at the beginning of my career, insurance is cyclical. You might beat the pants off of Liberty Mutual one year and the next year, they're half of what you are. Or one quarter, you might feel like you're crushing Progressive auto rates, and then the next quarter, you're losing people to Progressive. Like it can be very cyclical. The timing isn't always in sync, which I know is frustrating, you guys, but it really is also a good talking point that, okay, well, maybe that company hasn't changed yet, but they might, right? Like that doesn't mean they're not going to change just because they haven't. Like filings with commissioners can take a while, especially if an insurance company makes a file for rate change and it's denied. And then they have to go back to the drawing board, redo it, and then bring it back if they don't agree with the commissioner's negotiation of the rate increase than they can get. So maybe their intent was to have a rate increase before your company, but because their rate increase was denied, they had to go back to the drawing board, and that slowed some things down. So I do want you to understand that can take place and does take place quite frequently, actually. The amount of explanation will vary from person to person. So in this case, I'm actually talking to all of you that you need to be aware of your communication style. Some of you are fast talkers. You are high level. You just spit it out. This is how it is. You're blunt about it. There's no sugarcoating. Your tone may be fantastic, so I'm not calling you curt, but you're just very up top. Some of you are very slow and methodical and detail oriented and analytical, and you want to make sure that every single question, every stone was turned over. Here's the problem. The person on the other end of the phone, under side of the desk, other end of the email might not be like you. And that is going to create not the best, I won't say unsatisfactory customer experience, but not the best customer experience, because customers want to be spoken to how they want to be spoken to. So what I mean by that is I am a high level person. I'm a fast talker. I'm impulsive. I don't care about details, right? So if I call to add my kid to my insurance and the person on the other side is so terrified to tell me what that price is going to be, and they're just like, well, you got to understand there's teenage drivers. Yeah, I know. I've already had 2 teenage drivers. So, well, here's what I have solutions. And they're just going like, I'm going to get so annoyed. Just tell me that he's $300 more a month and let's call it a day. Right. Like, and I'm all for solutions. Like, give me the price. And then if I want to change, make some changes, increase some deductibles, do some things, great. But like, I want the price. I don't want a song and dance and smoke and mirrors. Just give it to me straight. Right. So you really do need to be aware of how the person wants it delivered. Do they want just the basics and the nuts and bolts, or do they want detail? Because, and you have to be able to sort of like, I don't want to say be intuitive, but you have to listen to like how they're asking the question. And like, if you're explaining and they're like, they probably aren't hearing anything you're saying anyway. So what I would do in this case is I would often ask people, how detailed do you want me to get on this? So homeowners increases are an excellent example of that, right? Because sometimes there's 5 different reasons why the rate went up. So I will say to people, I can give you bullet points. And then when we get into each bullet point, if you want me to go deeper, I can. But I don't want what could be a 5-minute phone call to be an hour phone call if you don't want that. Like, however, much as you want to know, I'll give it to you. But other than that, you got to really let that person sort of drive that conversation. Do not use internal jargon. So if you have a premium increase explanation thing on your system that says, policy code 49321 was changed to F4635. No one knows what that means. No one, not even me. And I read rating manuals. So don't read that, or don't even read where it says, oh, client had a birthday. Okay, that may literally be the reason why the rate went up, but you don't want to be like, client turned 55 rate increase, because just the delivery of it is terrible, right? That's going back to my third point. How you deliver it matters. So instead of like saying what you literally are reading on your screen, saying like, well, when there's changes in our ages, it's like a bell curve. When you're younger, you're higher risk. And then as you get experience and stuff, it goes down, down, down. But then as we start aging, it starts to go up again, not only because as we get older, we're not as quick, more wrecks because insurance is done off law of large numbers, but also because your group gets smaller. Like my grandpa is 97 and is driving. Probably shouldn't be, but he is. So, there's maybe like 10 other people in Ohio that are 97 and driving. It's not a big group is what I'm saying. I'm like a million with me. And so you just really be careful, because I know that a lot of you are very transactional. You just want to read what's on the screen, but sometimes it's going to take interpretation, translation, a little empathy behind it. And then sometimes people just don't know what you mean. And so if you're like, well, we're seeing a lot of BizRule claims. No one knows what BizRule means. So just be really, really careful about doing stuff like that. And then make sure that you are pausing with true intent to allow the client to understand and react. And what I mean by that is, let's say that you do something and the rate goes up by $100, a month. I'm just making this up. And you're like, so that'll be $100 a month. Do you have any questions? Like, I know that is appropriate terminology to ask if you have any questions, but really stopping and saying, okay, so now that you have the price, and now that do you want to look through it and see what we can do to maybe lower some of that? Is this what you were expecting? Do you have questions? Because some people are just stone cold silent, right? So it's like pulling teeth to get them to interact with you and explain. But if you don't give that person the space or permission to sort of say, oh my gosh, are you kidding me? Guess what's happening? If they hang up after you rattle off, anything else I can answer for you? Okay, have a good day. They're shopping, right? So you want to give them the environment to say how they really feel, even if this is horrible. Your rates are horrible. Let them vent. Like, you would much rather work with them and help them through it. And you still may not save them, but it is far more likely that you can salvage a relationship, fix the problem, and work through it with a client on the line versus them hanging up, shopping, and then you get a cancellation request. to go back and save someone after cancellation request is like mission impossible. It's like trying to go up an escalator that's coming down. It's not impossible, but it is definitely harder than if you had just gone down the down escalator, not the up escalator. So also offering solutions to the problem. Like I said, you know, the rates are what the rates are. And as long as you're quoting properly. But after you say what the rates are, offering solutions, and honestly, guys, sometimes and most commonly, this is in teenage driver situations, I will give like a precursor to the solution offering. I'll say something like, I'm going to give you this price. Are you, and even if it's high, I'll be like, are you sitting down? Like, are you prepared? This is a big one. And I'll be like, but just so you know, we're going to stay on this phone. And I'm going to give you some solutions. I'm going to give you some ideas. We're going to talk through it. Okay. Okay. All right. Your kid is going to cost you $400 a month to add on to the policy. And then I let them have their moment. And then we get back to business for solutions. So sometimes I will tell them ahead of time that we are going to work through the pricing and give them a heads up. Not always, but sometimes. But I always try to say, how are you feeling about that? Do you want to look at some ideas on what we can do with that pricing? You know, we can work together. Some people are like, nope, that sounds great. Even though I might be dying inside, like, you gotta be kidding me. There, and I'd be like, that's fine. You know, so you just really don't want to sell out of your own pocket that if an increase happens, whether it's a renewal increase or a transactional increase, that you couldn't afford it, or that would make you leave, because that is what is wonderful about all of our individuality, is that we're all individual, and what would make you leave won't make me leave, right? And it isn't even about money. Like, I'm so service oriented that you could give me a premium decrease, and if you're a jerk, I'll probably leave your agency. Like, I can't deal with jerky people, right? So everybody has their triggers, their attention span, and that is really a lot of the keys to having successful rate increase conversations, is about all of those moving parts and dealing with them the best way possible. So I'm going to hit a couple of things here. Some other reasons why, or some main reasons why we're seeing premium increases go up, is dwelling increases, which we will get into this in the nitty gritty about why dwelling increases are going up. And then also their car kind, or the type of car they have. So it could be that they had a 2017 Highlander, now they have a 2022 Highlander, and they're losing their ever-loving minds because it's the same car, but it's war. So those kinds of things happen. Tickets and accidents, claims, and then sometimes just personal situations like removing a driver, adding a driver, marital status change. So I'm going to try to hit all of these, but if there is something that you are dealing with, not like an anomaly, not like a one-off, like, you know, my insured bought a UFO and is mad about the price, like, make it up, but something that you commonly deal with, if it's not within these, yes, please send it to me on Q&A so I can make sure I address it. But these are kind of the most common ones that we're seeing all across the country at different insurance agencies. So first one, property dwelling increases. So I cannot express this enough. Market value does not equal replacement cost. What I mean by that is what someone pays for a house and what is the insurable value in the dwelling section don't correlate. They might match. It's a coincidence. But that replacement cost should be the amount of money that it takes to replace that house with like, kind, and quality in the event of a total loss. They can rebuild it and put the person back into the same size house with the same luxury values, you know, whether it's laminate or whether it's tile floors, heated floors, if you're fancy like that, that all needs to be the same. And they need to be able to rebuild with the same thing, but that does not have to do with market value. Yes, your heated floors might come into play when you go to resell your house, but so does the school system. So does the crime rate. None of that has to do with your insurance. So what is causing these replacement costs to inflate isn't because there's only 2 houses for sale in your area. It is because when you're talking about rebuild of like, kind, and quality, you have materials and you have labor. So average increase since last year for labor is 10%. Why? Supply and demand. And then you have a combination of new construction and remodel. So for example, if you're back, I'm trying to think of what year this was, 2007-ish, the real estate market kind of went, right? So, but financially, people were having issues in 2007 as well. So not a lot of people were doing remodels on their own homes because the extra cash wasn't there. And then new construction kind of came to it because of the mortgage industry. So from a supply and demand issue, you could get labor at a pretty decent rate because they weren't that busy. Well, now you have two things. There's a lot of new construction happening and people are remodeling their homes because they're home and they're looking at it, just like me painting mine. Like, I don't want to look at a taupe wall anymore, right? I redid it. So that I did it myself because there's no labor, but that is the supply and demand I'm talking about. In addition to that, you layer on the fact that for every 5 workers that retires from that trade, only 1 is entering it. And this is a real problem for me because I didn't go to college. And I openly say, if people went to college, good for you. Like, I don't have the attention span for another 4 years. Like, I am not diminishing the value of a college degree. Good for you. But we have corralled and hurdled all of our children. I have 4, so I can say this, to go to college. They're not all college materials. Some of them need to be apprentices. Some of them need to use their hands and be skilled workers. And because we have sent everyone on to secondary education, and not like, hey, let's learn how to be a construction worker or a welder, or we're missing all those people. So you kind of have all these forces that are playing into that. So that's a 10% increase. Then you have materials. Steel mill product costs are up 108.6% over last year. Soft lumber costs are up 101.4%. Gypsum products, which is like your drywall, your plaster, 21.7%. So when you guys talk about rate increases, because we got to learn how to separate them, not only for communication with our clients, but also for your own knowledge in speaking intelligently on the product. A dwelling increase going up is going to result in a premium going up, right? But that's not necessarily like a premium increase, how some of you are saying it. So they're two different things. Your insurance company might be raising your rates, and that's the rate increase. But the market or the dwelling value going up in order to stay in line with replacement cost regulations, that is not a rate increase. That is a necessary price adjustment to compensate for the fact that your house now needs $100,000 more to be rebuilt. So this usually only happens at renewal. So you could have 2 neighbors with the same exact house, everything's the same. One with one carrier, their dwelling is 400,000 and another is 500,000. And it's because the 500,000 person already renewed and went through that, where the other person hasn't. And then the other thing that you have to realize is that our construction costs are typically, no matter where you work, controlled by a third party. So like one of the most common one is Marshall, Swift and Back, not Swift like Taylor Swift, but I think it's SWOEFT or something like that. But that is the acronym MSB, which is used by like American Modern and a bunch of stuff. But they basically put in like, this is how much brick is, this is how much drywall is. Like they control all of that. So they are in the know and they are keeping up with that stuff. So they really do know what they're talking about when it comes to those rates for labor and materials. So if you have people whose replacement cost values are through the roof, one, it could be right, but I do encourage you, whether it's new business or it's a review because they call in because they're mad, go through the details of the home and make sure that you don't have somebody who's actually brick veneer listed as brick. That is a huge pricing difference. If they have luxury vinyl, don't have them listed at hardwood. 2 different labor rates, 2 different material rates, right? So it is possible that it's right. It is also possible that it's wrong, but that's why we have to have conversations with our clients and work through these things. So I'm just going to peek at the Q&A real quick and see if anything jumps out that I want to deal with on this. Okay. Had a homeowner renewal last year, 405, this year, 499. Exactly. And that may be right. Like that's just how the cookie crumbles. Okay, Tammy, I will definitely answer yours, but not yet. Oh, insurance scoring. So some of you are going through transitions where they're either getting rid of insurance scoring or they're implementing insurance scoring. And basically what I would say, if that's the reason why your homeowners or auto rates are going up, is trying to explain to them, what that change is coming from. Is that a company change? Is that a state change? Because if the commissioner is requiring that all the companies go to that, you're not alone, which puts you in good company. But I definitely stay away from the word credit. And the reason why I stay away from the word credit is because a lot of insurance scoring algorithms have nothing to do with a credit score. And you just end up with your foot in your mouth trying to backpedal because somebody's like, I have an 855 credit score. I shouldn't be a 14 out of 16. That's not, it's a risk management tool, and they're looking at how someone uses their credit, how maxed out they are, when's the last time they inquired for credit, when's the last time they opened credit, how many open lines they have. There's so much more to it. So my best advice to you is to find out, is that a company thing, and learn the reasoning behind it so that you can have a good conversation. Or if it's a state thing, why did the commissioner do that? And then when you're explaining it, try to stay away from the word credit. So Robert asked a great question. He said, I understand that material costs are crazy right now, but what happens next year when the lumber goes back down? Most of you don't have an automatic rate decrease on the renewal, dwelling decrease on the renewal. The reason why you have them going up is because it's a replacement cost policy, and in order to stay compliant and in line, and so that agencies don't have to look at every single renewal, there's this PIA adjustment where property will just increase with going through the calculator, automatically renewal, and spitting back out a new value. But you can manually do them at most companies. So if you do a policy review next year and you go in and you hit the refresh button and you change nothing, it may drop, but that typically has to be manually done. So keep that in mind. So I had to do this in 2000, I think it was 2007. Gas was like $4. There were some crazy things. I saw huge spikes in RCT, and the next time we did the renewal, went through them all, and a lot of them came down. So it is possible, but it typically has to be done on a manual basis. So somebody asked me, are you saying that other insurance companies have not started increasing rates to cover labor and material? Okay, so let's separate it out. There are company rate increases, and then there is dwelling replacement cost increases. They are two separate things. Most of them have probably had their labor and material rates adjusted because it's being done by a third company or third party like Marshall, Swift and Beck, but it will not hit that client's homeowners policy until the annual renewal. Okay, so that's why I say if you have two neighbors, everything's exactly the same. One might be at $500,000, one's still at 400,000 because the 400,000 person has not renewed yet. So that is why you would have discrepancies when it comes to labor and materials. Most companies they're keeping up with that, because it would be terrible if somebody had a total loss and you couldn't replace them because you didn't have enough dwelling coverage, right? So most companies, they don't delay that. What I was saying on the delay for company-wide rate increases, which have nothing to do with the dwelling, is if a company says, you know what, we're having some loss issues, we projected wrong, we need a 7% rate increase. If they go to their commissioner and file it, and the commissioner's like, you're not allowed to raise rates 7%. You just filed a 15% rate increase 5 months ago. Go back and come back and bring me something different. What I was saying was they may have had the intention to raise it 7%. They had to go back to the drawing board. Now your company already did a rate increase. And so you're feeling like because your company's rate increase came first, that you're on your own island alone. It's just that things are going to happen at different times, because unless there was an actuarial mistake, which happens, it happened at one of the biggest carrier, like $1 billion underestimate on reserves for auto actuarial assessments years ago. Unless it was something like that, chances are when weather patterns change, when claims frequency change, when there's severity, it is affecting every insurance company. It's not like the storm only hits American Family Homes, or also how they deal with it, how they offset stuff. And sometimes, guys, insurance companies decide not to raise increases, even when it's needed. Like they're looking and they're like, at one point, State Farm was paying out $1.36 for every dollar they were collecting in premium in the Cincinnati area. This was years ago. They did not raise rates. They were in the red so bad, and they did not raise rates. They eventually raised rates like a year later, but they were holding out to see if Mother Nature calmed down, right? So they did not pull rate increase like we were doing, like 72% rate increases. And they were like, we're going to wait. Eventually they did come back, but you know what the big difference to me was? I had people screaming, you know, it's doubled, whatever. But here's the thing, my homeowner rate at the time, even with a 72% increase, was 600 and State Farm's was 1,000. So I'm like, okay, if you want to shop, go for it. Like, even though I just almost doubled you, I'm still way lower than anyone else. So you also will have that. You have to remember that just because your rate went up does not necessarily mean you are still not the best option for that client, whether that's a service option, a price option, a coverage option. Heck, they might rent their house out Airbnb and you've got them with like a host advantage rider. There's no other company out there they can go to. You are the only option. Like, you got a monopoly on that risk, right? So I feel like when you guys see rate increases, you immediately think, I'm going to lose this person. And that is just not fact. And so what we need to do is we need to have these conversations, and we need to be able to truly understand them and then reciprocate them with good knowledge, because what you don't want is just to rattle a bunch of stuff off and people think you're just blowing smoke, right? So we definitely want to make sure that you really understand what I'm telling you today. So Madison asked, can we use these numbers with our clients? Yeah, sure, absolutely. And Google is amazing to get data. So if you would rather get it really isolated down to like not a countrywide number, but more so specific to your area, get on Google and see if you can get some information. Call your local shop, ask them if you get your car fixed somewhere, or maybe you know some people in construction, talk to them about it, guys. There is memes out there about lumber. Like, literally, there's a truck full of lumber and it's like lumber in 2019, $200. And then 2021, one piece of lumber, $500. Like, there are memes about it. Like, it's that bad. So this is not made up stuff. All right. On the other side of the fence, you have automobiles. Parts and materials are up 10 to 20%. Labor rates are up. There are 51.15% job openings in the automobile repair business. I saw a 6-figure sign for someone to get a job at Abra like 6 months ago. 6 figures to be an auto mechanic. I'm not in a high cost of living area, guys. I live in Cincinnati, Ohio. I'm not in a cool part of the country. So there's too many jobs open. You have a supply and demand issue, and hourly rates are up 159% since 2017. In addition to that, you have a part shortage, which is another supply and demand issue. But then you also have advances in technology. Bumpers in 1990, probably everyone didn't have a camera, didn't have a blind spot sensor, didn't have an airbag sensor. You know, the safer the cars get, the more expensive they are to repair. So let me kind of give you a visual for you to really understand this. I think it was like 7 years ago, my brother was looking at a Mercedes, and don't ask me what model, because I don't remember. All I know is that the dealership was going on and on about how safe it was. Like, my brother and his family would be so safe. And basically the car was going to crumble around them to keep them protected. So he called, he got a quote, it was astronomical, to add it onto his policy. So here was the answer for that. If I run 2 cars into a wall 50 miles an hour, and on the one car, the humans and the vehicles share the brunt of that impact with injuries and sustained damage, that's one thing. But if your car is specifically built that the car takes the brunt of the collision and the car is going to crumple around you, that means that my costs to repair or probably total out are going to be much more than the other car, right? Which is a great thing, because cars can be replaced, materials can be replaced, people cannot. So, but the problem was he was used to probably paying like $400 on his collision for his vehicles on average over the years. This one was $1,500. And it was all because of all of the technology and the safety features and the way that it would react in the event of an accident. So there is sometimes a lot more to it, which is also your answer for people on the whole, I bought the same make and model, newer year. Well, okay, well, what does this new car have? You know, maybe that bumper is $2,500 and then that bumper, it was $1,500. Well, when you take that over the thought process of a whole entire car, that's a huge difference, right? So like my windshield for my vehicle is like $400. My husband's windshield for his Tesla is like $1,700. So it just, there's just going to be different price points, and really learning and understanding and then giving people back explanations that they can comprehend and understand are just a really critical part of working our way through these increased conversations. All right. So premium increase reasons that can be a little bit uncomfortable. Maybe they got a ticket and we ran their motor vehicle report. You know, can you adjust the coverage for just their car? Can they, you know, if it's a kid and it's co-titled, or maybe the title can be changed to the kid's name, can we spin them off? You know, things happen. I mean, people get angry about this stuff, right? At fault accidents, tickets. But at the end of the day, and I would never want you to outwardly say this to anybody, but for strength and confidence, and for just you not getting your day ruined because you're getting screamed at, you have to remember they did that, right? They did that. You didn't wreck their car. You didn't speed. You didn't pull them over. You're just the messenger. You're just there to provide solutions. So you can listen, do not engage in battling. But at the end of the day, they're not mad at you. They're mad at themselves when it's like a self-inflicted rate increase reason. Maybe they were like, I just wasn't paying attention, or I was in a speed trap. Maybe there's a reason why they're mad, right? You just have to try to find solutions to a problem that, unless you own a time machine, you really can't fix. Now, on the accident side of things, I do want you to look at accidents and make sure that there's not something wrong. I have had not at fault accidents booked as at fault. So things can happen. I've had things double booked before. So I really do want you to put your eyes on the accident and make sure that it is being, you know, properly used. I also want to make sure that the accident forgiveness, if they had purchased it or if they had earned it, you know, is that pricing out properly? If you're going to answer questions, if somebody calls and says, I'm thinking about making this claim, do I have accident forgiveness? If you don't know what the heck you're looking at, and you don't understand how to read your system, or you don't know how to read a policy jacket or rules and rates, please get help. Because the worst thing you can do is tell somebody, oh yeah, you can make that claim. They make a $900 claim and then their rate goes up $500 every 6 months. So after a year, they're already in the negative. They never should have made that claim. So make sure you understand how your accident forgiveness works, whether it's purchased, whether it's earned, and then have they already used it? And then, so you don't give them bad advice. And then in the event that all that is right and the pricing is correct, can you change coverages? You know, try to make the bodily injury, property damage, the most critical coverages, try to make those the last thing that you touch. But, you know, maybe they have AAA and they're never going to make a towing and labor claim, but yet every car has, you know, $100 roadside. Or maybe there's 2 drivers and 4 cars and every car has rental on it. See if you can take those off. You know, again, this is not something that you can reverse. You're dealing with what you're dealing with. And if they go get a quote, the accident's going to show up, right? So you just have to do the best you can to provide solutions when people get into pickles like that. So when we talk about claims, there's a couple ways to go about this. People do not understand that the amount of the claim does not affect the price. It doesn't. People think, oh, well, if I make a $900 claim, then my rate will go up this much. But if I make a $90,000 claim, my rate will go up this much. That's not true at all. It has to do with whether you're at fault on the auto side, and then frequency. Usually 3 years is the monitoring period for chargeability on an auto policy. Sometimes 5 years for discounts. So if you have an at fault and then you have another at fault within the 36-month window, that's one price point. But if you have an at fault and then you wreck and then it's added at the next renewal, but then the other one now has expired off, now you really only have one at fault, that's going to be a different pricing algorithm. So the frequency in which they're happening matters. Also have conversations with people about deductibles, because like somebody might say, I like having a $250 deductible. Okay, wonderful. But let me ask you a question. Like if you have a $600 claim, do you plan on making that? Yes, I do. Okay, you don't want to do that. And let me explain why. And it isn't that I can't give you a threshold, like don't let anybody make a claim over $600 or under $600, because it is going to vary from policy to policy. Do they have young drivers? Do they have collision? Do they have comprehensive? Do they have this? It's a whole formula. One person may be able to make a $600 claim and be just fine, while another person makes a $600 claim and their rate goes up $700 every 6 months. So as you're working with people, whether it's during just a review, new business, any time, and you're talking about deductibles, you really need to make sure that people aren't planning on making a whole bunch of small claims if they're trying to keep their deductible low, because that doesn't work out well for anybody, because then you also have non-renewals that can happen. An insurance company can cancel the policy for making too many claims, even if they're just a bunch of $500 claims. Frequency matters. Then you have the probability. And what I mean by a probability of a claim is if you have somebody who has an accident forgiveness, and let's say they try to use it on a $600 claim, you can say, well, I know you just added Johnny last month to your policy, and this isn't his accident, is it? No, it's mine. I hit a pole when I was doing holiday shopping. Okay, you might not want to use your accident forgiveness for that $600, because usually with young drivers, it's not a matter of if, it's a matter of when and how bad, right? Like we have to have these conversations, because those will help us in the event that little Johnny does wreck. Well, mom already used the accident forgiveness. Now we have to deal with a rate increase conversation, right? So I'm trying to hit this from a couple of different areas of you guys, not only on how to deal with them when they're happening, but also how to be proactive and keep them from happening, because people do appreciate value. People pay attorneys $400 an hour. People pay doctors, usually copay, but to go see a doctor for 10 minutes, just to make sure you're all right. It could be $50, $75. Like, people will pay for a service, but if you're being transactional and you're not being educational and you're not explaining things to where they're fully satisfied, now the price is important, and you are making the price the focus, because they don't feel like they're getting the value from you that they want and need and crave. And not everybody is like that, but a lot of people are. So make sure you educate, make sure you make people understand that it is possible that your rate increases will actually outpace and outweigh the value that you get from a claim. That is possible. And then again, making future claims. Like I had a lady that wanted to make a storm door claim, and she didn't have any roof damage, just storm door. A tree branch flew and hit her door. She was insistent, $50 homeowner deductible. I think her policy was from 1901. But anyways, I'm like, we're having hailstorms like every 2 weeks. Like, you don't want to do that. And she insisted. So we did. And guess who had a hailstorm claim 3 months later, right? So you can't please everyone. You can't convince everyone. But the point is that you have to have that conversation. And so all of this kind of pretty much aligns on both the auto and property side. So we would tell clients that if they're considering making a claim on the smaller side, because we would say your insurance policy is meant for catastrophic losses, large catastrophic losses. If you want to make something that's a little bit on the smaller side, maybe under a couple $1,000, give us a call. We'll work through it with you, because guys, not everybody has a couple $1,000. Making the claim is the only option. But as long as you tell them, hey, you're going to have a rate increase, like they're like, that's fine. It'll be like a loan. Because I had a theft on my home and my premium doubled. And at the end of the 5-year period, I basically paid back everything that the company paid me for my theft claim. But at the time I was broke, and you could look at it like I got a 0% interest loan. But it's really about warning people and having those conversations. Then you get into personal changes, right? So we talked about the birthday a little bit, but you also have marital status changes can get a little dicey. This can come into play when it's widows as well as divorces. So I'll do the widow one first. So there is widow, married, single, divorced rating in a lot of insurance policies. But then there's also this thing called like policy rating factors. So I'm going to address them separate. The marital status rating, for some of you, a widow is rated the same as a single person. So basically, actuarial people say that married people are more responsible and less likely to wreck. And then I guess if your spouse dies, that makes you risky again. I don't know, maybe you're going to go out and hoot and holler all around town. Makes no sense to me, but it is what it is. You just have to own it. right? You just have to say, unfortunately, whenever there's a marital status change, it leads to rating algorithm changes. You don't even have to say your rating is higher for a widow, because it's just insulting and that will not go over well. So if you just say, when we make changes like that, the whole policy resets and it does a reassessment, and then it just basically gives me a premium amount, and then my job is to work through it with you. So let's talk about your spouse's car. Do you need 2 cars? Are you going to keep that car? What are you going to do with that car? Like, I take the focus away from the fact that the rate just went up, and I immediately start giving solutions. Let's talk. What about this? What about that? Right? So, because a lot of times it is left with 2 cars and they are going to sell it. And so I'll do like a fake endorsement, like, oh, once that car comes off the policy, this is what you'd be looking at. Oh, and then they're like, oh, great, because it'll sell fast. No problem. Or I'm going to give it to my grandkid. Okay, great. So it's just, don't dwell there. Don't beat the dead horse of the obvious that the widow rating is terrible. It is what it is. So, but some of you will have 0 difference in widow rating, but then your rate goes up and you're so confused. So policy, class determination, or kind of like the score they get between the insurance score, how many drivers do you have, how many tickets, how many accidents, it spits out a number. Okay. So that's like we're going to call it your policy class. One of the things in a lot of those calculations is how many drivers and how many cars are there. So if there's more cars than drivers, common sense tells us, normal people who think normally, they just like toys. They just like toys, right? They like having an extra car. Maybe they want a Jeep and a sports car. Maybe they want an SUV for the winter and a little coupe for the summer. To each their own, right? Unfortunately, actuarials and insurance people think that they're hiding a driver. It is priced in there. Like, why would anyone have 4 cars and 1 driver? So they're not, like, if your driver is really good, they have a strong insurance score, clean driving record, everything about them is great. Maybe, they get a rating, and I'm totally making this up, guys, but let's say they get a 1 out of 5. They get the best rate possible. Well, you got this extra car, and they're like, well, who's driving that car? So if you have that kind of policy, basically what they do is they slap that car with like a 4. And they're like, well, we don't know who's driving it. It could be somebody who's loves to speed or has a terrible driving record. Maybe it's a live-in boyfriend that they never added. So there's usually reasons, but I think the way that if you cannot figure it out, if you literally can't find the words, or it's just a difficult conversation to have, like the widow conversation, the best thing you could do is be honest about it. Well, this is what the system is telling me will be your new rate, but I have questions and I have solutions. Just come right out with it. Work your way through it. Be empathetic, be understanding. So if somebody starts yelling and say, I think that's terrible that your company is raising my rate when I just lost my spouse, there is nothing wrong with saying, I 100% agree with you. I would feel the same way. And we're going to talk about that, right? Like, being a human goes a long way. So remember that with your empathy. And then adding and removing drivers. Sometimes if you have like a 17-year-old at home, and then you have a 20-year-old who goes and gets their own car in their own name, and then you take them off, and all of a sudden the rate goes up and the person's screaming that they removed one young driver, you don't understand. A lot of that is, if you have an average driver rating policy, it's that the 20-year-old's experience and age is helping offset the young person. So let's say that there's a married couple and 2 kids, 3 cars, right? Everybody is rated at kind of like not 100% rate. But when you remove that 4th driver, now everybody has 100% driving rate, because there's 3 cars, 3 drivers. So young kid with hardly any experience and is younger, his percentage of driving the cars goes up, which makes the rate go up. So I know that sometimes doesn't get translated the best with people. So the way that we try to say it to people is, when you remove the driver who has a better rate because of experience and age, then that makes all the other drivers have a higher percentage weight towards the rate decision. And because that person that's left, the younger driver, maybe a person who's not even younger but has a worse driving record, instead of them being rated at 60%, now they're being rated at 100%. That is what is causing your increase. So that's kind of how we explain it, if that helps, is with the driver rating percentages, if that applies. Again, how you say it matters. You might not have the most glowing personality. You just might not have a real strong empathy bone, and that's okay. This is what I want you to do. If it just doesn't come natural to you to deal with people, especially people, some people have very thin patience for people who are wackadoodle and just ridiculous in their conversation styles, and you'll just shut down. But I need you to kind of try to at least follow this, especially if you're burnt out on rate increase conversations, really telling people, because every person's a new person, right? I understand how you feel. I'd feel that way myself if my homeowner rate doubled, or if my value of my dwelling cost went up $200,000 and made my premium go up. But what I've found is that, is it better to pay an extra $50 a year? And we can always revisit it later when these lumber prices and labor gets under control. Is it better to go ahead and pay that $50 a year? Or would you rather that we didn't do what we're supposed to do as your agency and your company, and find out, heaven forbid, if you had a total loss that you're short $200,000? You wouldn't want that, right? So sometimes you have to just perspective. You got to pull people into the conversation, and you just have to ask them point blank. Like, these are construction professionals saying that you need an extra $200,000. You don't want us to short you. How mad would you be if you were $200,000 short? And instead of tile, you get linoleum. And instead of brick, you get vinyl. Like, no one wants that, right? So kind of like putting it back into put the ball in their court, and kind of having that, and then coming to an agreement on, what the solutions for dealing with the rate increase are going to be is the best way. So I'll come back to that in just a second. I'm going to go through some of these Q&As and chats real quick. So how can we address when a spouse dies and the premium goes up just because the love of their life is no longer with us? Oh my God, Tammy, I love the way you said that. First of all, acknowledge that they just lost the love of their life. I'm telling you, people, empathy and humanity go a long way. Like, people will appreciate just the sentence, "I'm so sorry for your loss." But if you don't even acknowledge the fact that they've just lost their spouse, and you just go right into like premium discussions, you've already kind of lost them, because they are looking for that connection, because they are sad and lonely, and you have to be that person. And it really can oftentimes mute out any premium discussion after that, because you've now made them feel comfortable and appreciated, and you hear them, and people will pay for that, to be heard and seen by the businesses that they are giving their money to. So keep that in mind. Whenever we are quoting new business homes and they are concerned about their dwelling costs is more than their current policy, would we explain that the increase in material? Yes, Sarah, good job. Okay, so basically what she's saying is she might be using current labor material rates, but yet the competitor's policy hasn't gone through a renewal. And so they haven't really seen that, and then they're questioning it, right? So that is definitely a go-to answer, is like, well, it's possible that since we've had some of these increases, your policy at the other company hasn't renewed yet, and so it hasn't caught up with the increased costs of rebuild and labor. The other thing is, you could say, or it could be that the details of the home do not match. Like, I have your house at 3,572 square feet, brick siding, semi-custom interior. Do you know what they have you at? It's possible they have them at 3,000 square feet with basic everything. Like, all of that stuff matters. Natasha said that she doesn't see lumber costs going back down, and she may be right. I don't know. All I know is it's expensive, because I'm in the middle of a lot of rehabs and it ain't cheap. So it may go down, it may not, but we are in the thick of it, and we're going to have to deal with it. So somebody says, what does it mean on a manual basis? What's the refresh? Oh, great question. And I apologize for being too high level on that. So when you have a dwelling increase, it's automatic at renewal with PIA. Like, it'll go through, and then you'll just see it on the policy. Like, last year they were at $300,000, and now there's this extra line for an extra $33,432 with the premium, right? It's automatic. But when it goes through renewal the next year, let's just say for conversation's sake, materials and labor down, it is not going to drop that off. You have to go in and do a policy endorsement, usually open up the replacement cost calculator and hit calculate or refresh or whatever the button on your system is to get the new replacement cost amount at that time And then that will tell you whether or not you can lower the dwelling back down or whether it hasn't changed at all. So somebody said, curious, where do you find the product cost percentages? I did research on some websites with, if you're talking about the lumber and material costs, I did some research on some websites. So, but I'm sure if you Google it, it'll all be out there. Just make sure that you use 2021. So you're not getting like 2017 articles. But if that's not what your question was around, let me know and I'll be happy to answer it. So yes, a window for a new Mercedes-Benz was $1,900 with the lane sensors and adjustments. Yes, see guys, they're getting more expensive because I had a Mercedes-Benz once upon a time, and I think the windshield on that one was only like $600, and that was Chloe was 17, maybe 8 years ago. So that's how much these things have gone up. Wouldn't it be far more expensive for us to pay for injuries rather than a vehicle replacement? Yes. So what Tiffany is asking is, you know, when we're looking at the car, the explanation I gave about the Mercedes crumpling around the family, what she's saying is, right, but if we had to pay out, you know, in injuries, wouldn't that be far more expensive? However, when it is the people in your car, they are not covered by bodily injury usually. I mean, you might have a state thing that's different, or maybe it comes back under the uninsured motorists on your policy, but bodily injury is for other people in other cars. So I'm talking about the car that our insured owns and the collision premium associated with it. If your resident relatives are in the car with you and they're also hurt, we don't pay that out of BI. We typically pay that out of either PIP or medical payments, which like our medical payment cap is 100,000. You can't get more than 100,000. So it's capped. Whereas on bodily injury, you got millions and whatever. So, and you have health insurance, which is like a co-insurance things for the injuries, right? But the vehicle is just the vehicle. And that is what Mercedes is telling us what the repair costs are. And if somebody wrecks it and then they got to go get it repaired or it gets totaled, we got to cut that check. Right? It's just us and them. So that's why the logic behind that. Somebody said, is there a specific percentage that homeowners insurance will go up by, or is it case by case? It is 100% case by case. Couple of things. One is the dwelling increases that you're seeing will depend on the materials within the home. That's why I want you to double check and make sure somebody's not listed as brick, who's really brick veneer, or somebody's not listed as wood siding, who is actually vinyl siding, asbestos when it's actually hardy board. Like, make sure all your details are correct. So that's on the replacement cost rate increase. Homeowners rate increases that are company rate increases could be because they were under collecting the year before. Maybe your weather patterns changed in your state. You would know that better than I would. But then you also have situations where fire departments change. If levies fail, if somebody goes from a staffed fire department to a volunteer fire department, if, you know, they consolidate fire departments and town classes change, that can lead to huge rate increases. And guys, again, just like the accidents and the claims, you're just the messenger. So you can be compassionate and you can be empathetic. Like, I'm so sorry this is happening to you. But at the end of the day, you didn't vote that levy down, most likely. You didn't cause the ISO to change from a 2 to a 7, causing a massive increase. It went 10 levels, right? That is beyond your control. So all you can do is explain it and then dig to see if maybe it's wrong. Maybe you need to do a fire department appeal and the ISO scored wrong. They can be wrong, but that is another thing that leads to rate increases that is completely out of your control if it's accurate. But then when it comes to losses, the not only the frequency, but the peril on the property side matters. We rate higher typically in the insurance industry for fire and liability, and then water. Actually, theft sometimes is above water. And then, you know, your wind and hail are down at the bottom, but there are different risk factors. So just because if somebody had a fire claim and somebody had a theft claim and then somebody had a wind and hail claim, same payout amount, same date of loss, same everything, you're likely going to see the wind and hail may have like a loss of discount, but no surcharge. The theft will probably have a loss of claim free and then a surcharge, and then the fire is going to have the loss and then an even higher surcharge. So it is very complicated, but again, the amounts don't matter. It's the peril and the frequency and the date of loss that matter. So recommendation on how to explain a price increase for an auto renewal that only carries liability and uninsured motorists. Okay, so what I do is I go through policies, like I'll pull up the last renewal and the new renewal and kind of like look, and usually there's a smoking gun. Like sometimes I'll see the collision on a car went up, and then I'm like, okay, clearly we underpriced this car last year, so now it's catching up. But then let's say that you see that there is no collision and comprehensive, and so either the BI goes up or the UIM goes up, right? And that's where the increase is coming from. You basically just have to explain to people that when they're setting rates in the insurance world, they're projecting payouts, right? And then those payouts are put into like a pot and then divided among people in a very generic way. If medical costs are double, then we have to then double our projection on what we're going to pay out on medical, right? Because medical isn't always under medical or PIP payments, it's under bodily injury, because we have to pay that person's medical bills that we're responsible because our client was at fault, right? So all of that goes into play. When you have advances in healthcare technology, would people need rate increases to keep up with today's inflation because gas is $100 a gallon? Those people work at hospitals and doctors, and then they're asking their bosses. So like, I hate to say it, I'm not an economics professor. And again, I didn't go to college, so I'm gonna give you a very watered down version, but when prices rise, things rise. It isn't just about the raises of the people that work at the hospital or the equipment. It's also about keeping the lights on. That might be more expensive. The mortgage might get more expensive. Like as things get more expensive, it all trickles down. So what if we used to pay for back surgery for fusion of a slip disc because of an accident, we used to pay $100,000. Maybe now that is $400,000. Like I saw a settlement the other day that was $300,000 for a fractured leg in a car accident. $300,000 for a fractured leg. I'm like reading, like, is he a landscaper? Is he a professional sports player? Like, why does he need this leg? That should have a value. Zero explanation except for a $300,000 settlement. So everything is going up, and then all of that basically trickles down, because as much as I wish we weren't a for-profit business and industry, we are. And it does come down to money. We can be as compassionate as possible and as understanding as possible. But at the end of the day, guys, this is a business, and any increases are being made because of numbers and data, and not because they're personally out to take down your agency or your clients. There are reasons. And that is why we really want to have to like dig in there and figure out what is going on, so that you can have those conversations and not only be knowledgeable, but also empathetic, understanding, and giving solutions. So I hope that all of those things, kind of combined together can help you have better conversations. I know that it's 4:00. So if some of you have to go, I want to be very respectful of your time. I'm going to stay on for a few more minutes, so y'all can hang out with me if you want. But for those of you that are bouncing off, bye. Thank you so much.